Good morning, friends. Today, in our series of accounting and finance, we are going to discuss with a new concept called capital structure. So here we are going to discuss about what is the capital structure of a company and what are the component or what are the key component of the capital structure. So basically, capital structure refers to a mix of debt and equity. It uses to finance its operations and growth. Essentially, how a company funds its assets, and it plays a crucial role in determining the financial health, risk, and overall value of the company. So, following are the two key components of a capital structure. One is debt, and another is equity. Debt is the amount which is borrowed from the external sources like banks and bondholders, debenture holders, whereas equity is a fund which is raised by selling the ownership of the company shares or stock. So these are the two key components of debt and equity, and the combination of debt and equity is called capital structure. And capital amount of capital structure is invested in the assets of the company for the purpose of generating revenue and return on investment. So this is also called the amount which is infused in assets of the company in the form of investment, and the investment gives the company ROI, return on investment. And when the ROI from this investment is more than the cost of these two key components, so we can say the company is doing good, and it increases the overall wealth of the shareholder. And obviously, when the wealth of the shareholder in the form of market share or market capitalization increases, the overall value of the firm in the overall value of the firm in the market increased. So there are few terms that are associated with the capital structure. One is financial health, second is risk, and third is overall value. When it comes to financial health, capital structure impact a company's ability to meet its financial obligation, and obviously it impact the financial health of the company as well. There are certain risks associated with the capital structure. When the proportion of debt more than equity proportion in a capital structure, the financial risk of the equity shareholder increases. As a result, the cost of capital, overall cost of capital get increased, and equity can dilute its ownership through this. Third is overall value. The optimum capital structure required by every company. When a company able to achieve the optimum capital structure, it minimizes the weighted average cost of capital, means overall cost of capital, cost of equity in debt gets lower, and maximize the value of the company. So there are certain these are the concepts which are associated with the capital structure. Finally, there are certain ratios which are used to understand how the capital structure is performing. First ratio is debt to equity ratio. Through this ratio we can understand what is the mix of capital structure. Like debt to equity means how much is the debt, how much is the equity. Second is debt ratio. It measures the proportion of debt financing relative to total capital, means how much debt we have in our total capital. Third is called equity ratio. Equity ratio basically measures the proportion of equity financing relative to total capital. So in a sense we can say a company capital structure is a strategic decision that impacts the financial as well as its ability to achieve the goal of the company. So guys, this is all about basic understanding of capital structure. Soon we will come up with a new video in our series of accounting and finance. Till then, thank you very much. Stay good. Thank you.